Can you see me?
Yes. Yep. Yep. I think we are live.
Yes, we are live, and we see people coming in.
So
welcome, everyone.
No more picking my nose. Got it. Perfect. And you see the slideshow too? I got the slideshow up, right? All right, good. Excellent. So give everyone a few more minutes to connect, and then we'll get going.
Yes.
Sounds good. You'll get this, honey, because you have kids same age as mine. But about a week ago, kids brought home that cold from school. And I was like, oh, man, it's going to mess up the webinar. And then I got it, and then I started feeling better. And I was like, perfect timing. And wouldn't you believe it, 2 days ago, sniffles again. They all came home and started. So if I break down the coughs,
I hear you. And now winter's coming here, so all hell breaks loose.
Yeah. How cold does it get out there
in Tel Aviv?
Mm-hmm.
I need to translate into Fahrenheit, and I don't remember, but it's not that cold. It's just the nights are cold, but not as cold, and we don't have snow, like only like really up north, and just twice a year, and then you see like all the traffic because everyone wants to see snow one time a year. Yeah.
Well, here in Texas, it's kind of the same way, and we go out every time anything gets white. We butter up all the kids. We run outside, like, oh my gosh, it's snow! It's snow! Oh my goodness! And you're out there, it's just ice. It's not snow. You can't play in that. It hurts.
It hurts, and you can slip, right?
Yeah. You get out there for a couple of minutes. You're like, yeah, all right, well, that was fun. Let's not do that again until next year.
Okay, so I think we'll give people 2 more minutes because I see more and more joining us. So I think that can be good. Sometimes the internet, sometimes during doing something. So we're patient.
All right. That sounds good to me.
All right. So where are we standing? So what do you say, Alan? Do you want us to start?
Yeah, let's rock and roll.
All right. So okay. So I would assume people would keep joining us, and that's we're just getting started. But for everyone that is already here, hi, thank you for joining us for the webinar on cleaning your books before hauling into the new year. My name is Hani from Workies. I'm from the marketing team, and I'm very excited to launch this first, yet not last, webinar that will be followed by more professional content webinar for pros, where we host experts to discuss burning issues and provide insightful information to you guys. We're getting started, and the chat is open for you. So any question you have, anything that comes up during the session, just send it over, and we have a designated Q&A at the end of the webinar, and then we will take Alan will take questions from there. So let's start, shall we? So I'm very happy to introduce you to Alan Holmes, a business advisor from Texas with over 20 years of experience in tax and accounting, working in the trades and consulting for over 20 years, and owning in-source books specializing in the field service and construction industries. So thank you, Alan, for joining us and taking the time. And you take it from here.
All right, super. Appreciate it, Hani. Thanks everyone for showing up. We're going to have some fun. I know we're going to talk about accounting. I know we're going to talk about tax, but we're going to have some fun doing it. So I'm on a time limit, Hani says, so I'm going to keep rocking and rolling, and then we're going to get some questions at the end. So
yeah, and I see and I see people. Hello from Buffalo, New York, North Carolina. Very, very excited to see everyone joining from
all
many
over the place.
Yeah.
Some of these people are under snow right now, actually.
Yeah.
And here in Texas, like I said, it got down to 50 degrees the other day. We busted out our winter parkas. Whew, we were not ready for that. So,
all right.
All right, here we go. Today's agenda, real quick. We're going to talk about the year-end books, right? Why it's stressful, why we have to deal with it, what's going on with our stuff. We're going to look at how do we tell if our books are clean, and maybe some common reasons that there's some issues with them. How do we fix them? We're going to briefly talk about some tax requirements to keep in mind. And then the really fun part I'm looking forward to is how to use that financial data to really grow your business, right? So instead of just throwing money at a problem, we can actually drill down and grow this business. So I'm super excited about that. And then if you watch my promotional video that Hani made me do, it only took me 51 times to make that video correctly, but the turkey talk. We're going to do a turkey talk at the end. We're going to talk turkey. We're going to talk about your business, answer any questions. So get them ready for me. All right, starting off, we're going to say, why is the end of the year so stressful? Well, it starts just with ourselves, and we all do this. The holidays, shopping, family get-togethers, travel, cold weather, like we just talked about, that 50 degrees. Whew, just it's miserable, and winter illnesses, kids bringing home the colds all the time, and crazy drivers. Just the other day, I went 2 miles down the road to the grocery store and almost got hit 4 times. I don't know what it is about the winter, but people just get crazy. And so we have this stress as we get to the end of the year, all this stuff filling up. And then some genius decided, hey, we ought to make them file tax returns and get their books cleaned up at the same time that they're dealing with the other stuff. So we've got a lot of stuff coming in. We've got informational returns. We've got tax returns. We've got everyone's sending us paperwork. Here's your reports. Here's your statements. Here's the stuff that we're reporting to the IRS. Make sure you get all this stuff done. And as business owners, we still have to get in there and check our books and make sure that this stuff is correct, because we're starting a new year. We're starting a new fiscal year, and we want to make sure that we're on the right foot going forward to help grow our business. So that makes the end of the year stuff a lot more stressful, I think, than first quarter, second quarter, or doing monthly reconciliations, things like that. But we're all in this together, and don't worry about it, because we're going to run through some of this stuff. We're going to help and then see what we can do. So first off is, how do we know if the books are actually clean? Okay. Tie points. If you're not familiar with what a balance sheet is, all right, you need to find it. The balance sheet is very important. And a lot of people don't just dismiss it right off the bat. In fact, I had a CPA tell me the other day the balance sheet just meant BS. That's all it was. And I was floored. No, wait a minute. How can you tell the business? How can you tell how successful the business is without a balance sheet? The balance sheet is your snapshot in time of where the business is, how much cash flow it has, how much liquidity it has, everything else. We need to tie the balance sheet. And at the end of the day, the balance sheet is what verifies our income number. So you could spend all day, all week, all month trying to fix out numbers on your income statement. But if you hadn't fixed your balance sheet, you're never going to get to the right tie point. So the best part about the balance sheet when you're doing this is that every number can tie to a report. If you look at your balance sheet, you'll see cash right up front. Here's your bank account. Guess what? You got a bank statement. The bank statement ties to that. If there's a discrepancy, that's why you have a bank reconciliation. Maybe you have some outstanding checks or something like that. But otherwise, these numbers tie. And if they don't, that's where you're going to start. Make sure that all those transactions are in there. Your accounts receivable ties off to your invoices. It ties off to reports from your invoice software if you're using multiple software. And let me just back up here too. The balance sheet, people get overwhelmed by these financial statements. Oh, balance sheet, I don't know what it is. It's really, really logical. If you sit down and you read it and you think about it, it's what it says. Undeposited funds, for example, are funds that you've received from a customer but hadn't put into the bank account. So open up your desk drawer, and if you see $50,000 sitting in your desk, that's your undeposited funds. If you see $50,000 or $100,000 on your books for undeposited funds, but you can't find it, that probably means that it's not correct. All right. Again, the other day I had somebody had a cash on hand account of $50,000. I said, man, that is a hand I would like to shake. But quite frankly, they don't have $50,000 sitting in their hand. So it shouldn't be there. Fixed assets, moving on. Fixed assets. If you purchase any fixed assets during the year, if you got yourself a new truck, equipment that has a useful life of more than a year, it's going to go here in the fixed assets. You've got purchase paperwork. You're going to hang on to that. Your CPA is going to want that so they can do some depreciation for you. Credit card, here on the liability, you've got credit card statements. Again, it's the same thing as a cash. You can reconcile off to the statement amounts. Accounts payable, you've got unpaid bills. If you have a stack of unpaid bills on your desk, that's your accounts payable number. If you've paid all your bills, your accounts payable is taken care of. You shouldn't have a negative accounts payable unless you've somehow overpaid your vendors or something like that. But it doesn't really happen. Payroll and sales tax payable, those numbers are always seem to be off quite a bit, but you're filing quarterly payroll tax forms, you're filing sales tax forms. The numbers that you report to the government should be the numbers on your balance sheet. That's a tie point. Notes payable. If you've got notes payable, if you have any loans, like a loan for that truck, you have a payoff balance on that loan document that ties right back into your balance sheet. Same thing on the profit and loss. We have some tie points, not quite as many, but it's important here because the revenues, for example, you'll get 1099s. You'll get 1099s from some folks. You'll get 1099Ks. I don't know if y'all are aware, but the 1099K is for a lot of credit card processing, and they changed that requirement this year that it's now the threshold's only $600. So everyone's going to get these 1099Ks. You don't want to, the 1099K is reported to the IRS and given to you. You don't want your revenue numbers on your profit and loss to be lower than the numbers that the IRS is expecting, or they're going to come back and say, hey, something's wrong. And if you are unlucky enough to be audited, one of the first things that the IRS auditor will do is look at the revenue number that you have on your report, and they're going to get a stack of bank statements, the 12 bank statements, 12 monthly statements, and they add up the deposit number on those statements, and they look at the revenues, and they say, why is that not the same number? And if it's not the same number and you can't justify, oh, hey, look, that was a loan that I put into the bank, that was an investment for me, that was an investment from somebody else, you've shot yourself in the foot for credibility, for all the other expenses that you have to deal with. Payroll. The payroll numbers need to tie, again, back to the reports. You've reported to the government, here's what your payroll is. Make sure that payroll is on there. Don't start adding things into payroll that don't tie to the number that you've reported to them. Contractors. Outbound 1099 forms. You need to issue 1099 forms. We're going to talk about that in a little bit, but the amount of your 1099s ought to equal the amount that's written in your contractor expense. That just gives you credibility for what you're doing. Interest, again, that goes back to the loan documents. If you have a payoff balance, you've got interest expense. Most everything else, though, you don't have any tie points. So if you're really particular about those, if you're not comfortable with the balance sheet, if you're not comfortable with making these numbers work, that's where you keep up all your receipts. Your receipts are verification of these things. IRS requires some sort of documentation to prove these things. Now, a bank statement, if all this comes off of a bank statement or a credit card statement, that will suffice most of the time. Sometimes you need that receipt. If it's a meal expense, there's certain IRS requirements for doing that. And I think some of you guys said you were from Canada, so I'm sorry if we're talking too much US stuff, but the point is you got to keep documentation of certain things. Those are the receipts. The P&L is a lot harder to tie to because it requires a shoebox full of receipts to tie all these numbers together. The balance sheet, on the other hand, these are statements that you're getting from your bank, getting from your lenders, things like that. All right. That's our accounting overview, which brings us to our first turkey joke, as I promised in the promotional video. And these come courtesy of one of my colleagues and her husband who works for the Postal Service. So thank you, USPS. Which side of the turkey has the most feathers? The outside. Turkeys do not have feathers on the inside. All right. What are some common causes of inaccurate books? Now, if you've just followed along with me and you checked your books and you say, Alan, these books are great, great. Now you have a joke. Go text it to your kids. We're going to talk about some of the issues that we have, some of the things that pop up and how to fix them going forward. Some of the common inaccuracies that we see, duplicate transactions. All right, I specialize in accounting information systems. Your system will put the information in there sometimes, and then sometimes you go in and put it in, you end up with a duplicate. Sometimes you put it in and then you go to sleep and you wake up the next day and say, hey, I need to record these expenses. It happens all the time. So duplicate transactions, missing transactions, you just forgot to put it in. It didn't show up anywhere. It didn't. Sometimes your bank account doesn't sync to your books. Undeposited funds. So let me start with that. The first two, when you have transactions in your transaction stuff, that's why we do the reconciliations. That's why we link our accounts to our QuickBooks or to our accounting system, and then we do reconciliations. We verify, the first thing we do is verify that all the transactions are in our system. From that point, we can start moving stuff around. Undeposited funds, as I said, unless you're sitting on a pile of cash, or maybe it's negative undeposited funds, that generally happens because so that generally happens because you have recorded a deposit in the bank, but not used the payment that has been recorded in the system. Or vice versa. You said, oh, here's a payment that I received, but that didn't come from an invoice. You have to follow a certain workflow to get through it. So you send an invoice to a customer, you give an invoice to a customer, they pay it, right? So at the point that the invoice is created, you have accounts receivable. Customer pays it, the accounts receivable is decreased, and you have undeposited funds. If you were paying cash, which is not a great idea in this world, and we're going to talk about that in just a second, but with a credit card, it still has to go through the process, right? Before it's deposited into your account. So it's basically in a holding account, undeposited funds. And then at some point, when that money gets funded into your account, it goes from undeposited funds to a deposit. If you circumvent that system or you break that system in any way, you're going to have problems with undeposited funds. Probably the number one problem that most people have is undeposited funds. So definitely need to do that. Payments not being applied to invoices. Again, the same system. You receive a payment from a customer. If you don't apply it to that invoice, it's just a payment. It will come over as a negative accounts receivable, but it doesn't actually, it creates a negative accounts receivable. How do you write that off if you don't have an invoice attached to it? So you got to make sure the payments come in, apply to the invoices. Deleting invoices after processing the payments. This is your workflow. Again, you've put this in here, you've received payment, it has to stay connected. It goes to undeposited funds, it goes to the bank account. Anytime that you break that process, it's not going to work. So it's really important. I think it's really important that you focus on first of all, make sure that whatever invoice system you're using is also the one you're collecting payments in, because you don't want that gap. You don't want to be over here using ABC Corp for this and XYZ Corp for this. If those two things don't link together correctly, and there will be sync issues, you will have an issue where, oh, that didn't connect like you thought. Man, you're going to be all over the place. You're going to be cleaning up books for the rest of the year. You don't want to do that. Let's start off by getting them together. All right. The second point, again, I talked about that just a second ago, is to go cashless. If you got a tech out in the field, honestly, you got internal control issues here. You don't want your tech going out and doing a bid, doing an estimate, and saying, okay, it's going to be $400 to clean out this garage, and then coming back and saying, oh man, I had to talk her down. She didn't want to do it, and I talked her down to $200, and pocketing the $200. And you, as a business owner, you're not going to see that. I mean, you're losing money right there. You're losing accountability. And then you've got $200 in undeposited funds that get stuffed into your drawer until the time you get to go to the bank. And that stuff disappears too. Checks disappear all the time. So definitely want to keep all the systems together. And the last one is including common inaccuracies, including non-business related or non-deductible transactions. I think I miswrote that, but you get it. If it's not business related, if you have used your card for something personal, you went to the ice cream store and you accidentally paid with your corporate card, that needs to get out of your books. It's not deductible. It's not a business tax. It's not a business expense. It's not going to help you with taxes. It's not going to help you with seeing how your business is prospering. But if you're in the business of buying ice cream for your crew every day, okay, maybe that's a business expense, but just like that. So some of the things that we need to do to make sure we talked about: match the deposits to the invoice payments. You've got to match your reports to the invoicing system. So when you have an accounts receivable, whoever's doing your invoicing ought to have reports that says, here's what my sales were, here's my invoices, and you should be able to track those in your accounting system as well. When you're making loan payments, again, we're tying that loan payment to a statement from the provider. So we need to make sure that the interest is split out so that the payoff balance is showing. Make sure that you're applying tax payments. If you go and you pay your sales tax or you pay payroll tax, that has to go against the liability. Those get out of hand. And categorizing the transactions. That's the last one. Just categorizing the transaction. You got to do all that stuff. And of course, for internal controls and for ease of access, go cashless. Welcome to 2022, almost 2023 now. This is the way the world works. All right. Now we got past a lot of the accounting stuff. We're going to get to some more fun stuff. That's right. Taxes. Everybody's favorite subject. But we're going to do this one really quickly as well. So some common tax requirements. I'm not going to run through all the tax laws here. But just to keep on top of your mind, while you're planning your holidays, while you're picking out presents for the family, while you're doing all that, and try not to get run over by crazy drivers, you got to also remember, you've got local and state filings coming up. Every state, every country, you've got information reports, franchise reports, margin reports to keep your business in good standing, in addition to the actual tax reports. 1099 NECs, you're going to be getting those from some people, and you're going to be giving them out. If you have any contractors that are working for you, you got to make sure that those contractors, anybody you paid over $600, is receiving a 1099. It's on the tax return. In the United States, there's a box that says, I have filed any 1099s that I'm required to. And if you check that box and you didn't file your 1099s and you sign off on that tax return, you just lied to the government, and they don't like that much. So make sure we get that covered. Payroll filings. Hopefully we have an integrated system that's actually processing the payroll. If not, you got to make sure that those are getting done. 1099Ks, those are going to be coming in. Don't want you to freak out about them. They're just coming in. They're going to come in this year, especially. And then the tax basis financial statements. You're required to have tax basis financial statements to do the tax return. You want those just to make sure that it all ties. And I'm throwing this one out there since I've been preparing taxes and working in tax office in a long time. Here's some stuff you can do to make your tax preparer happier. Instead of shoeboxing this stuff or bringing it to you piecemeal, we're having to do an extension and do it all in the last day. Get your financial statements together. Pull up your account statements if those are applicable here. So bank statements, if it's not reconciling or there's an issue, just give us the bank statements while we're at it. We can take a look at it. Any payroll summaries. We're now required on business tax returns to notify the IRS to to say, here's how many employees we had and what forms we filed. Otherwise, we are not allowed to electronically file without that information. So we got to get the payroll summary. If you're a subchapter S corporation, we got to have owner's pay also. It has to be separated out. Asset list. If you purchase new assets during the year, give us the paperwork on it right up front. Any notes that you have, I love notes. Absolutely love it. You got a question, I don't really know what to do with this, Alan. Write me a note, stick it in your paperwork, or send me an email, or send your tax preparer an email that says, here's what I'm thinking. Just let them answer it. It puts it in the front of their mind. And of course, any IRS documents, any of the 1099s that you get, any notices you get, anything like that, pull all that together, put it all together for your tax preparers, save them a tremendous amount of stress. We cross taxes off the list now. So joke number 2, because I did promise some turkey jokes. Why did the turkey cross the road twice? To prove he wasn't a chicken. That's right. And don't worry, I know you're laughing. My 5-year-old cracked up on that one too. So let's see. How can we use financial data to make our business more? All right, here's the good stuff. This is what I like. Key performance indicators. All right, that's a buzzword. That's fancy stuff. You'll see it a lot when you're looking into this stuff. KPIs. Here's some KPIs. Here's some stuff. And all we're really doing is we want to look at any kind of statistic, any kind of way that we can track how your business is doing financially, and then measure that so we can see how your business can grow. So we take these financial ratios, and these are some benchmarks, and I pulled these off from Solid Waste, since this is the junk haulers webinar here. Just some standard KPIs. These are just financial ratios that they've come up with. Some of them are relevant. Some of them may not be relevant to your business, but that's what you establish. And I think Hani mentioned that. We're going to talk about that in an upcoming webinar, how to set this all up going forward. If you've already set it up, fantastic. Here's your chance end of the year to take a look at it and see, how did you do this year? How are you going to improve next year? And that's all this is. Fancy ratios, a lot of this stuff. So we're going to talk about a couple of them that I feel like are a little bit more valuable and that you can do right now, whether you've set it up or whether you've not. But here's some benchmark information for you that you can set up. The 3 valuable KPIs that anyone can use. I think one of the questions I get a lot is, how do you make your business grow? And really, there's only 2 ways to make your business grow, right? You either have more income or less expenses, right? I mean, that's what you need. When you're talking about making your business grow, you're going to hire more people, you want to expand, right? But at the end of the day, we're all here to make money, okay? So how do we do that? We got to have more money coming back to us. So we got to figure out, how can we get more income or less expenses? And what we don't want to do is throw money at advertising that's not working for us. It doesn't make any sense to do it. So that's why I picked out the first one, is a percentage of revenue spent on marketing. If I took your advertising expense and I divide it by the revenue, I can see how much we're, a ratio. And all we're going to do with that ratio is then measure it, right? Once you've determined that, we just keep measuring it going forward. So we can look at it on a monthly basis. You look on an annual basis. Right now, you can look at it and say, how did I do this year versus last year? And that's called the trend analysis. So we can see how you're doing it. The second one, also really relevant, is percentage of revenue spent on payroll. Especially in these kind of industries, right? You've got your crews going out there. That's a big expense. I'm going to back up here. On these benchmarks here, it's the same thing. The revenue spent on payroll, if you guys can see that right there, the industry standard here in the Southwest region for 1 to 5 million is 23%. That's a big chunk of your revenue that's going out to payroll. And that's something that you need to keep tabs on. If you're paying out a whole bunch of payroll and they're not able to generate those things, they're not able to close those sales for you, that's something that you need to touch base on. So right here, that's something we can track. And the current ratio, current assets over current liabilities. The importance of this is you got to make sure you have enough liquidity, then enough cash. I say cash on hand, but again, that's not what we're talking about. We're talking about available cash that's at the bank that we can spend to pay the bills that are coming up in the next month, in the next 12 months. That's cash flow management. If we go back, the benchmark there is 3. Right? They're saying we have 3 times as much current assets as we have over current liabilities. That means 3 times. We can pay 3 times, up to 3 years, or whatever the period is that you're looking at, of our expenses coming up. So that's a very important one. Anybody can do these. Once you've cleaned up your books, you've got these handled. But here's the thing. Garbage or gold. And you guys who are in the junk hauling business, you know this, right? You go out to somebody's garage, you go out to their shed, you go out to the storage unit, and you go to clean this stuff out, and you find this really valuable antique thing, and they don't want it. You know, they say one man's trash is another man's treasure. But we've got to determine, is this good or is this not good? And there's a saying in the technology industry that says garbage in, garbage out. And that's how it processes things. If we put in basic numbers, we're going to get basic results. We're going to get these numbers, you know, some industry standard benchmarks here. So, okay, yeah, our gross margin, great. But if you want to drill down, if you want to be that business owner, we want to look at targeted return on investment calculations. And we're going to target those. We do this every day. Should I buy that? You go to the store and say, should I buy that? Can I afford that? I was really thinking about getting that 72-inch plasma TV, but can I afford it? Can I find a better price? Maybe I should search on Amazon, Walmart, something else to find this better price. And do I have time for this? Do I have time to come to this webinar? And all of you who are here today have said, yes, I'm going to make that time investment because that's important to see my business grow, to make sure I've got these year-end things. And that's awesome, but everyone has to make those decisions. In business, we have to be more intentional. So instead of just going shopping and say, should I buy this dump truck today? I don't know. We have to actually drill down these numbers and say, where are we earning our money? Which revenue streams are most profitable? Is it more profitable to go out to the residential stuff, or are my contracts in the commercial side? Is that better for junk hauling and waste removal? Which advertising campaigns? All right, you've got Google, you've got Yelp, you've got Facebook, you've got all these things, which are actually generating your highest conversion and close rates. Which employees are closing those? You got a guy who's going out to these places and he can't close anybody. That's a problem. He needs to be trained again to deal with that. But you have to be intentional about looking at your stuff. And if that employee is not working out, I'm here to tell you from experience, it's a hard thing to do, but you got to let them go if they're not able to do the job that you need and to generate those returns. And we see this stuff on the news all the time, 15,000 people laid off. And it's terrible, absolutely terrible. But these are intentional calculations that businesses have to do in order to continue being successful, and which expenses are not necessary for revenue growth. Again, are you spending money on something that you don't need to? Best thing you can do is spend money on things that help you make more money. If it's not making you more money, it's probably not. So you need to be more intentional. But how do we get that? All right. I mean, we talked about some general KPIs and things, but how do we get that? And this is all right. This is a report pulled out of WorkEase. This is my account in WorkEase. I've been playing with it. It's amazing. I've got ad spends. All right. It actually breaks down here for affiliates, Facebook, Google, Instagram. We're taking all this stuff and it tells us how many jobs each of these things created because they have a workflow that does that. We take that back to our financial statements and we apply dollar amounts to it. And we're going to talk about why that's a little bit important here in the next screen. But if you have this is what I'm talking about, gold in, gold out. So for some people, they may look at this and I don't know what that is. That's the same thing that your customers are doing. And you're collecting something, you're refurbishing it and selling it and making a bundle on it. We're able, if we can take this information, clean it up, add some, I mean, it's clean, but add some financial numbers to it. That's ridiculous. That's half my job right there. Is just pulling this stuff together for folks. And that's amazing. And here's, again, the employee cost. How many of our employees are closing the jobs? How many are going out and getting canceled? And we're looking at those numbers. And the reason that we can't just stop with these numbers and say, how many is there's more factors in there. This does us, they have more reports. I think the area reports, performance reports. Sometimes if you go to one neighborhood, you close a lot of jobs, right? I mean, they're more affluent over there. They don't care about paying $400. You go someplace else, you're not able to close the job. So there's some difference there. But the reason we apply those numbers is on the dispatcher performance, which I don't think I put in there, but let's say that you have your spouse or your kid, your niece, or your nephew helping you out with your business. You're paying them a certain amount. Well, you're not really going to fire them, but you need to know what those standards are, what they're able to generate. So applying that number, they may be working part-time. How much am I actually paying them? Well, I'm paying my kid a lot less than I would pay somebody, to come in. So if their close rate is lower, that's fine because I'm paying them less. So financially, it works out the same. So applying those numbers from those reports is your next step, and that'll give you very specific stuff. And that was it. Look at that. We're doing well. So we have limped our way through accounting, tax, business growth, which brings us to the limping turkey. What sound does a turkey with a limp make? Wobble, wobble. There you go. And that's it. Turkey talk time. I know I went through a lot of this stuff real fast. Hani, I don't know if we have some questions in there that I can help answer, but I really wanted to get to this point too, because I think this is going to be of value to folks. So fire away. Let me know if there's anything I can answer.
All right. So I see people are typing, but there are some questions, and we already asked people from the registration form to also send some questions. So we have some. So let's start, shall we? Are you? Yeah.
I'm ready. Let's go.
Thank you so much for all the information. Okay, so diving into the first one. So, how to track down records to file past unfiled tax returns?
Somebody didn't file their tax returns. Okay. Happens to the best of us. It's okay. Number of ways you can do it. All right. Right now, if you're talking about like individual records, I don't know what a record is. Go to the IRS website. You can actually log in. There was big news to do about it where you got to do facial recognition. You got to get your phone and you got to do all this stuff, but you can pull off what has been reported to the IRS, and you absolutely need that because the IRS has that number, and they're not real swift. They have a real old computer. We call it HAL from Space Odyssey, but you don't want to wake HAL up and get the wrong numbers. You must file what the IRS says, and then we start adding or subtracting from there. So get those numbers to start with. Secondly, go back and get your bank statements, get your credit card statements. Again, those are the tie points that we came on the balance sheet. When we tie all the numbers on the balance sheet, assets, we got assets, liabilities, and equity. All right. So assets equals liability plus equity. Once you've tied assets and liability, you'll know what equity is. Equity is basically your earnings plus or minus what you pull out of the business. So now you've got your earnings. You know what the number should be. You've got your bank statements, and you know what the IRS says. You're off to the races. From there, it's just adding in classifications and doing things like that.
All right. Thank you for that. Next question is from Joe. So, and I'm assuming it regards the fact that we're talking about the year end. It wasn't mentioned in the question, but so if I want to buy a new truck, would now be a good time to consider it?
Okay, great question. Fantastic. I kind of meant to talk about that. Great. Thank you, Joe. I'm going to give you the accounting answer, which is really tough for you. I understand. It depends. That's why we look at these financial stuff, the financial statements. When you're buying a truck of this size, we're talking about a fixed asset. We're talking about there's going to be depreciation on it. How much of that truck is depreciable? That depends on what your net income is. But most importantly, the most important advice I could give you right now is to think of it not from a financial aspect or a tax aspect, but from a cash flow aspect. Can you afford that truck? Can you afford those payments on the truck? Do you have the crew that's going to get on it? Because it's not just a truck, right? Unless you're converting from a trailer to a truck and it's still you and your crew, which is totally fine, then you've got it set. But if you're looking at expanding and buying that additional asset, you also have to know you've got fuel expenses. The fuel expenses on those trucks is way higher than it is on your pickup truck with the trailer. So you've got to take all this into consideration. Do you have the cash flow to manage that? Because you do not want to go out to buy the truck at the end of the year thinking you're going to save some taxes and then belly up your business because you can't do it or get stuck in those accounts receivable loans with the super high interest rates. I'm going to add one other thing. When people are talking about taxes and how to save taxes, I don't like to focus on that. Tax is a percentage of your net income. If you have a higher net income, you're going to pay higher taxes. But you know what? Our job is to have a higher net income. We don't want to cut down our net income to try to save 20% on taxes by cutting our net income by 70%. It doesn't make sense. So I think that might have answered it. Cash flow, look at that. Go for it.
Yes, thank you. Okay, one coming from Justin. So we look to lower the lead costs, and we're thinking of expanding our business to work with other businesses that might offer recurring jobs for us. What are the types of businesses we should pursue?
Um, I mean, you're talking about anything that builds. It's just going to be in the junk hauler industry. Is kind of what we're talking about still. I mean, it depends on your industry, right?
Yeah, I can't see the industry, but
It depends
most
on
of
your
our
industry.
businesses.
For me, I'm probably not focused on, since I focus on field services and construction, I focus on those type of things. If you Let's assume that we're talking about junk haulers because this is originally for the junk hauler industry. Um, where are they getting their leads? I mean, I had a meeting with the guy the other day for a lead source that was a caterer, and I couldn't quite figure out how accounting and catering matched together. I mean, yeah, you cater a wedding. So look at where their lead sources are coming from and make that determination. Are those the type of leads? Think backwards, okay? Who are the customers that you want to get? And work your way backwards from there and say, if I want to do residential, how am I going to get those residential? Then I'm going to go out and I'm going to make contacts with HOAs. I'm going to make contacts with, construction companies in new neighborhoods or bank foreclosures, cleaning out foreclosed properties, things like that. If your ideal customer is, builders, and you want to do that kind of stuff, you're going to have to go out to contractors. So look at who you want to be your customer and work your way backwards to who do they have interactions with. And those are the people that you want to make an acquaintance with and make a partnership with.
Yeah, and I'll just add from our side of the Workies side. I so we have both Workies accounts and those who are invited outside of Workies, but in our integrations we do have lead generation that is integrated into Workies. That we work with Thumbtack, we work with Angie, and we work with Google local services as well. So that's also a good way to pursue more leads. Thanks, Justin, for the question. Okay, so let's move on to the next one. Syncing over data from Workies to QuickBooks, how to categorize sales versus services.
Okay, yeah, great question. Workies does sync with QuickBooks Online and with QuickBooks Desktop. It's a couple different processes, but it works with both of them. Getting the sales in, it's important. There's two ways to do it. You could put just line item categories. Here's the sales expense. Here's the service expense. Now, most sales expense that you might have in junk hauler industry would be from getting something, like I said earlier, where, hey, that's worth some money. If I clean that up, I can resell it. That's a riding lawnmower that's worth $1,000. If it's just, put some oil in it, that's a sale, right? So then you're going to have, sales for that because you've got sales tax and things like that. But another thing, if you're actually making a lot of money doing that, if you're going to these places and you're able to do that, I would recommend creating two different classes. So you have one income statement, but it has classes on it. So you can see all the revenue and expenses you're generating from this revenue stream, which would be the services, and another one from the sales. That's going to be absolutely invaluable to you.
All right, thanks. One question from Kevin. I think it's for both of us, but I'll let you answer. So our payments are integrated into the Workies system.
Are payments integrated into Workies? Yeah, right. You can accept payments in Workies, can't you? Like a credit card payment.
Yes, of course.
Yeah,
More than that.
Yeah, then you got to do that. Yeah, absolutely. Thanks, Kevin. Again, you don't want all these different systems. You want a completely integrated system. If you're doing invoices over here, you want your payments over there. And I've looked at it again. I've done a lot of this stuff for QuickBooks, and sometimes I'm like, QuickBooks payments. I don't really care for QuickBooks, but putting it together, it's so much easier, so much more streamlined. Cuts out all those internal control issues. You got to do it. Absolutely.
All right. Okay, so two last questions. So one from David asking, this is our first year using WI. Will the 2022 values entered in the WI have year-end totals, particularly sales, costs, and profit?
What's a WI?
Just a second. I'm just sending it over to you as well, just to make sure that I've read this correctly. Just a sec. There you go.
Where did I find that at? In questions?
No, and in the chat, in our chat.
Oh, work keys. Okay, thanks, David. All right, sorry.
Oh, sorry, work keys. Sorry, David. I couldn't get the yeah.
Yeah, perfect. All right. First year using work keys. Will the 2022 values entered in work keys have year-end totals, particularly sales, cost, profit? If, and I may have to toss something back to Hani, but from my experience, if you put it all in, if you follow the work keys workflow, that's yeah, okay. I didn't mean to say it like that, but if you follow their workflow, you're gonna get that information back out. A lot of times I see people, oh, okay, well, here, let me just shortcut this and let me do this. And then the information gets all wonky at the end. If you follow their workflow, yeah, you're going to get those reports at the end of the year. You can get them now. Check it out now. If you're in WorkKeys, go in there and look at those reports now. You can break it down. I forgot, monthly, weekly. I mean, like really kind of granular type stuff.
Yes.
So if you check it out now, David, and find out if you're getting those reports. And if you're not, get on the horn with WorkKeys or get on the horn with me, and let's see if we can get those reports cleaned up so that by the end of the year, you've got them cleaned up perfectly.
Yes, and while you're in the system, David, you can also just click on the chat and ask for support, and we're there in no time. So
look at that.
All right.
Work is easy, right?
Yes. Okay. Last question. Oh, that's a cute one. Will this be recorded? I have a meeting. Hoping to be done on time to attend. I don't know who asked it because we got it from before, but for sure. And we are sending this over and by the end of this session. And I think we can wrap this up with this question because we reached our time limit as well. So I would like to say thank you so much, Alan.
Yeah.
And if you want to, yes, of course. So if you have any additional questions and need help, you have Alan's information. We will be sending also our information with the recording, as of course. And it was a pleasure to host you. Thank you for joining us and giving the time.
Yeah, thanks. And folks, answer I think they're doing the survey, right? So answer the survey and stuff so that I can come back, because I'm telling you, we're going to get into more of this growth stuff going forward in future seminars. So, thank you so much all for being here. And again, as Hani said, thank you, Hani, for having me. Thank you, WorkEase. And thank you all for being here. And if anybody has additional questions, I know it was really fast. Let me know. We'll figure it out. All right. Thanks, everyone.
All right. Thank you, guys.
All right.
Yeah, we're there topping also. Thank you, Lynn. Thank you, Z. Thank you, everyone that is writing back to us. We really appreciate that, and we would love to see you on our next webinars as well, and provide more useful content for you guys. And have a great weekend starting tomorrow. So see you guys soon.
Happy Turkey Day coming up.
Happy Turkey Day, right? Yeah. And have a very good New Year coming up.
Yes, all that. Yep.
Yes. All right. Bye-bye.
Bye.
Thank you.